Ghana's policy interest rate of 14.5% ranks second highest in Sub-Saharan Africa. That's according to Fitch Solutions Tracker of policy rates on the continent. Charles Nixon Yeboah has been looking into this and joins me with some more insight. So, welcome to the program, Charles. Now, what exactly is this whole policy about in terms of its numbers?
Well, policy rate basically is a rate at which the central bank lends to the commercial banks. And if you clearly look at the data, Ghana's policy rate, even in West Africa, is the highest. And in Sub-Saharan Africa, excluding North Africa, we are placed second behind Angola. And clearly it shows that cost of borrowing is very expensive in this country, and that is not good for the country in the sense that if businesses cannot borrow at a cheaper rate to inject into their operations, it's a problem. So clearly, going forward, we expect to see improvement in the macro economy. Before COVID, there were still challenges in the economy. Clearly, you could see that the fiscal deficit, i.e. expenditure vis-a-vis spending, as well as borrowing, was a problem. And clearly, it has rippling effect on growth and inflation, as well as some monetary indicators. But I would say that the central bank has done well to bring the policy interest rate from 25.5% in 2016 November to 14.5% as it stands now. And we hope to see a better rate going forward into the future. On the other hand, if you look at some of the indicators within the banking or financial sector, you could tell that cost of funds are also expensive. And the issue about non-performing loans, the issue about provisioning for bad debt is also a concern. So if we are not able to improve some of these indicators, then we would continue to see a high policy rate.
It's quite interesting you talked about the increase in bad debts and the non-performing loans, because we have engaged most of these banks, and they tell us the fact that yes, the policy rates are moderately low, but issues regarding lending to people, the probability of getting the money back, the risk is so high, they often tell us. Do you think this is justified?
Absolutely. You know, in banking, risk is a very key element. Credit risk, operational risk, market risk, and liquidity risk are very vital indicators as far as assessing a customer demand for loan. So you can tell that banks don't joke. They borrow from you and I. We deposit our funds with them as in savings or time deposits, and they lend some of these funds. If it goes bad, it affects the bank's capital adequacy ratio. So in that case, the banks have to be mindful in terms of lending. However, if we are able to do better in improving some of the pointers, I left out the issue about the addressing system. We saw the digital addressing system launched a couple of years ago, but yet still there are challenges. And until we see these improvements, we will still experience high cost of borrowing in this country.
But you have been doing a lot of reading within this, this field. From your perspective, do you think there is much hope that the cost of lending could go down?
Absolutely, because if you look at the spread between the policy interest rate and the lending rate, is about 7%, and that is quite good comparatively to previous years. The experience of the 20-something% policy rate, meaning that at a point in time you were borrowing at about 38% on the average, and when you compute it to 12 months, that means month on month, the kind of rate you are going to pay is quite high. And if you are borrowing at even 2.53%, it's quite expensive.
Charles Nixon Yeboah, many thanks for that analysis there. You're still watching Business Live with me, Charles IT.